expects a 25 basis point cut tomorrow, but he would prefer a more aggressive half-point rate slashing. Moody's chief economist Mark Zandi joins us now. Mark, great to see you. You've been in this 25 camp for some time. And I'm just wondering, because we were saying, there's probably not much of a difference in terms of the impact if you get 25 or 50 now. But in your view, at this moment in time, why is it better to do a 50? And what are the consequences of not doing a 50?
Well, I think the Fed achieved its goals, its mandate. It did that months ago, both in terms of full employment, the unemployment rate's just north of 4%. And in terms of inflation, I think the Fed's got inflation back in the bottle. So if they've achieved their goals, then, why a 5.5% or close to funds rate target? That's just why. It's just very high, and you're running the risk of breaking something in the financial system or the broader economy, the labor market. So given that, I think they should normalize interest rates as fast as they can, get it down to something. Now, there's a reasonable debate as to what normal means, is the so-called equilibrium rate higher than it has been historically? Probably, but it's not 5.5%. So let's get this funds rate down as fast as we can so that we take the pressure off the economy. Because again, we've achieved our goals. We've done mission accomplished. Let's, move on. Now, 25 basis points with, clear guidance that the Fed's going to be cutting rates in a consistent way at future meetings, kind of a dovish kind of 25 basis point cut. I'm not sure that's much different than a 50 basis point cut in terms of what it actually means for the economy. But, I think signals matter, and I think markets are poised for a 50 basis point cut. So I would prefer that. But, Melissa, having said all of that, my sense is this is a much more cautious Fed. It would be sort of out of character, a Powell-led Fed to do that. They tend to wait for, emergencies to cut 50 basis points, something going off the rails somewhere in the economy or in the financial system. So, yeah, I'd like 50. I'd like them to get rates down fast, but I suspect they'll be a little slower than that.
Hey, Mark, it's Tim. Thanks for joining us. And I guess, we're the traders, but if the stock market was the economy, the economy's never been better. What's the mismatch here? And again, why is it that rates markets are telling us something very different? I hear what you're saying about needing to normalize the Fed funds rate. But again, Fed funds out to 275, out to December of 25, and commodity prices that are pricing for a recession. Something's wrong here. Is the economy offsides or is the market offsides?
Yeah, it's a great question. I think the economy's doing great. It's fine. It's consistent with, record high stock prices and very thin credit spreads in the corporate bond market. The very aggressive kind of view on the rate cuts here going forward feels like the market is pricing in something that's not quite as good. Maybe it's the way the distribution of possible outcomes it looks like. Meaning the kind of the baseline forecast of traders is consistent with a really good economy, but they're attaching a higher probability to kind of a tail event, something that's kind of out there that will derail the economy, make things, go off the rails, very, very quickly. So it may simply be that they're just attaching a higher weight to those kind of very dark, risky scenarios, and that's why you're getting that kind of very aggressive-looking cut in rates in futures. But yeah, I think generally markets are saying this economy is doing really pretty well. By all regards.
So bringing it back to the conversation around affordability and all the focus that we're putting now on tomorrow, are we kind of like offsides in terms of where we're focusing on? Should we be focusing on housing affordability and some of like the initiatives that are being put on deck? Should we be reviewing that more closely, or should the focus be squarely on the Fed? Does it really address the underlying issues that both the political parties are speaking to and the consumer is feeling?
Yeah, great. That's another great point. You're right. The Fed can only solve so many problems, and we've got deeper issues with regard to affordability. You mentioned housing. That's the key one, right? Because that is the largest item in most people's budget, cost item in most people's budget. About a third of their budget goes to housing in one form or another. And that can't be solved by the Fed. The Fed can make things worse by keeping rates too high for too long, undermines affordability, and it makes it more difficult for builders to build homes that we desperately need. But we do need fiscal policy support here if we're going to address the affordability problem in a reasonably timely way. Now, look, we got into this mess with regard to affordability, the lack of affordable housing, the shortage over a generation. It really began back in the wake of the global financial crisis in the 08-09 period. So it's going to take us a while to get out of this mess, but I do think we could get out of it a lot faster if we started to address this with policy.